Hello and welcome to the Nest Edge. Looks like we are live now. I had a little bit of a hiccup there. But anyway, thanks for joining us for the Nest Edge for the month of May. So we named the Nest Edge, and I say this every single month because it's a new, we look at data, have a unique way of looking at data. We feel that gives us a pretty good edge over the choppiness of the markets and the news cycles. So, and of course, we always have to give our disclaimers that this is not advice. Even though we are advisors, this is not meant to be advice. This is an educational webinar. So use this as education for making more informed decisions. And again, this is how we do things. And in the game of investing, there's many ways to do things. People make money all kinds of ways. There's many ways to lose. There's many ways to win. But we are just discussing our process and how we do things. We've been at this for a combined 30 plus years. So we've been around the block a few times and seen a lot of different things. For those of you that have listened to our webinars before and would like to move forward in building your portfolio with us, please reach out to us at info@nestfinancial.net, and we'll be happy to talk to you and walk you through the process. I read recently where each of us knows 152 people on average. So if someone in your circle needs to grow their knowledge in investing, please point them to our webinars. That's what we're here for. We're here to educate people in the financial arena, and that's why we produce these things. Love to welcome them and introduce ourselves as through our webinars to new clients through our works and our conversations. This is a conversation between Sean and myself, and inclusive of our audience. So if you have a question, there is a Q&A on the side. Please feel free to type your question in, and I'll make sure to keep my eye on that, and I will bring up the questions so we can address them. So this is an interesting newsletter we put together this month, Sean. I love the title, "Sell a May and you're a dummy."
Yeah,
I thought that was great.
Yeah.
So what have you historically seen here from advisors in the industry?
Most don't do this. I would say most people, to a fault, are buy and hold, and buy and hold on for dear life is kind of what I like to view it as. Most do that. If I was going to say what most people do, but there is this segment of advisors and planners out there that the most common name I've heard them call themselves is like quants. Like they purely go off data, which I agree with. But they have no. They live in this linear world where they assume everything that's happened is going to happen again in just the exact same way. And that's just when you say it out loud, you're like, oh yeah, that doesn't make any sense. I mean, why would you do it that way? But I've gotten, or I used to, I don't anymore. I used to let wacky stuff like this bother me, and I've been in heated arguments with people that really, really do believe in methodology like this. That you can say, well, 60% of the time, if X happens, then Y will happen. So that's what you should do. Yeah. It's just like, what? Like that who gives a crap what happened in comparing,
right?
May of 1972 to May of 2021 is a completely different world. It's just it's a wackadoodle theory, and it comes up every year, and I get it's just wild. And then, when the whole history of it's even wilder.
We'll get into that in a second.
Yeah.
A lot of times people do things because it's been done before a certain way.
They're taught that way.
It reminds me of a story of, I think, 3 or 4 generations. One holiday season where you had the daughter helping mom, the young daughter helping mom with making a turkey, or it was a ham is what it was, and noticed that the mom cut both ends of the ham before she put it in the pan, before she put it in the oven. And the young 5-year-old asked her mom, "Why do you do that?" And mom goes, "I don't know why I did that." And she goes to her mom, which was in the house, and the mom also scratched her head and said, "I don't know why we did that either." Then they had great grandmother in the living room that was there and kind of hard to hear. And was like, "Hey, Granny, why do we cut both ends of the ham before we, put it in the oven?" And then she just starts,
She didn't know either?
No. So she starts laughing, and she says, "It's because back in my day, my wood stove burning oven was like this small and it wouldn't fit into the oven. And so she just started this thing years and years and years ago. And then just as an observer, you just kind of continue to do it. And even when it no longer makes sense, and not that this made sense at all, but I do want to get into the history of this. So talk about what you learned while doing research on this and where it came from.
I'll have to pull up, what was it? Originally, it comes from a horse race back in the 1800s, and we kind of went into this in the nest edge. So if you've already read it, this is going to be a little bit of a repeat. But there's some race called, was it St. Leger's Stakes? It's one of the, it's a big time. I'm not into horse racing, but back in the day, it was a big deal. Even in our country, like boxing and horse racing used to be the two biggest sports in the U.S., which is wild if you look at today's landscape. But in London, there's this race, the St. Leger Stakes, and the saying was, the original saying was, sell in May and go away, come back on St. Leger's Day. And somehow that got swooped into or cut off and sell in May and go away. And the idea is that, the stockbrokers of the day would, not work all summer and just hang out and party, I guess. I don't know how they got away with that. I don't know how it worked, but that's where the saying comes from. It's not a Wall Street thing. It predates. I mean, it predates. It's not from Wall Street. So, but the saying itself is not an American thing. It's from London and a horse race that has absolutely nothing to do with stocks.
Well, I love what you said in the newsletter, though, that these guys would just like sell and go to the pub for the summer.
Yeah. I mean, I'm jealous. I mean, that sounds pretty sweet. Like, what if we sent an email out today to all the clients and said, hey guys, we're going to cash. see you in late September and October. And, guarantee we're not going to lose anything. Like, and yeah, I mean, when you do the back test,
grow, but it's not going to lose.
Yeah. I mean, other than the fees you're paying, I mean, other than that,
is there any truth to the strategy when you back test? Was it sustainable at any point?
It depends on how far you look back. So the argument of the data that I looked is if you look back the last 75 years, there's some validity to it. Now there's a lot of outliers and it's really hard to take the data. So when you go that far back, it's just a completely different world. Right. If you would have told somebody that traded stocks on the exchange 70 years ago what it would be like today, it would blow their mind. 80% of volume that, exchanged on the markets is algorithm and machine based.
Right.
So it's just a completely different world.
Right.
The numbers that I found, if you look at the last 75 years, there is some validity to it. You could make the argument, and it's not earth-shatteringly major, but there was some validity that it was calmer in the winter months than the summer months. And here's the reason why, and I can tell you, the volume was lower. If people really were partying all summer, and that means they're not trading a lot, if the volume is real low and whoever is making transactions, prices will move faster because there's less, it could be one-sided. If people are dumping and there's not normally when there's buyers on the other side to off balance that, then the volatility calms down. But if there's only volume on the sell side, nothing on the buy side, prices get whacked. So that makes sense. If back in the day, if people took the entire summer off or took 6 months off, that's why it happened. Well, in today's world, there's way more money to be made. We can't take 6 months off. Like that's just, it's not going to happen.
Right.
So if you backdate it the last 30 years instead of 75 years, it's the complete opposite. It snaps back or becomes wildly inconclusive. I know I specifically looked at the last 4 years of this window and it was completely wrong. Like if you sold, you would have lost money. If you sold in May and went away and then came back after the race, then you would have missed out on money. So it's a complete gong show. But this is just kind of a snippet
Yeah.
of this view and this theory that you can look at backward looking data. Like I said, 60% of the time X happens, then Y will happen, and people will invest like that, and it is maddening. And again, it used to drive me nuts, but like I've kind of come to the place in my life to where like even if somebody tells me 1 + 1 = 5, I don't even argue with them anymore. I just go, okay.
You're more zen. You're like, okay.
I don't know, just zen or just don't care anymore. I don't care to beat this. He's going to dig in his heels or hers. It's not worth the argument.
Right.
It just
makes sense.
Ugh.
Well, for those in the audience, if you got any questions, please make sure that you throw it in our chat box, and I'll make sure we address it. But this is the purpose of these calls and these webinars, is just really talk about strategies, talk about mentalities, talk about how things have shifted in investing over the last 20 years, over the last 4 years, over the last 75 years. There's been so many changes, and we just have to keep up with these are all the aspects that we have to keep up with in growing investments and how days are changing and how we're looking at things today. Can you talk about, Sean, what things you're seeing being the most risk for investors today or at the moment?
If you think inflation's not here, it's just, if you're set up for inflation, you're fine or you're stable. If you think that this was at the mid-cycle transition phase, I've heard it called lately like this is just a transitory phase of inflation. If you're ignoring commodities and what that's telling you, if you're ignoring the currency markets, this week has been very volatile down. I mean, for sure, equities are down. Commodities are mixed, but definitely some are still up. Nothing in the equity space is up besides energy, it looks like. And that's just, people are spooked because there's this, all of a sudden there's inflation. ISM numbers came out today.
Will you explain what ISM means for people?
Inflation.
Okay.
Just, sorry if I buzzwords, but so came out year over year growth rate on inflation was 4.2%, which I guess that doesn't sound like a lot, but it's a ton in 1 year. The Fed's goal is 2%, doubled that. The Fed thought it was going to come out at around 2. Wall Street's expectations, and I hate saying that, but I'm just bringing this up to show you how far everyone was off. The street's expectation was somewhere around 3.2 and 3.5, and everyone's like, "Oh, that's way too high." I'm like, "No," and it came out at 4.2 today. So,
we talk about who puts these numbers out. Is it the government?
Yeah.
Okay.
Yeah.
And why do you not rely on these numbers?
I'm inherently suspicious of everyone. Step one. Step two, it's just, if the government is a political entity and people inside it are politicians often, these things that used to be, the Treasury wasn't a political entity. It was neutral. That's long gone.
Mm-hmm.
It's just they mess around with the numbers, or they'll just lie.
Mm-hmm.
I see it often, and it's just wild. But or they will state a number, and if you have to read the whole damn report, because at the very bottom there'll be some paragraph where they'll disclose something that completely changes the numbers.
Right.
Like they're like, yeah, unemployment's 6.1%. If you go to the very bottom, it'll say, well, we miscalculated and we changed up the math. And if you went back to the old way, well, unemployment's really 10%. Like, well, that's wildly different. You admitted that you changed the math.
Yep. So they're changing the narrative is at the end of the day, but it's not, it's in the guise of whatever political thing they're trying to accomplish.
It's a big time happens, and you got to do your own research. You got to do your own math, and it's not hard. It's insane. If somebody even I don't know how this snuck up on anybody. Like I've been yelling about this for 6 months. Go look at commodities, and you tell me there's no inflation here.
Well, let's talk about that, because I want to. There is, we talked about risk, and you said people are spooked because of inflation, but there is things that you can do with inflation. First, I want to chat about this 4.2 number compared to what you're seeing, how you look at inflation differently. So I guess you look at commodities and look at the pricing there, or what do you look at?
I mean, for me, that's the most important thing and really that's what it is input costs. The price of goods and services that you're out there buying, if the input costs are rising, that always flows through the consumer. The producers, they're in the business to make money, not to eat, inflationary costs.
Right.
So,
for example, give us examples of currencies. I mean, not currencies, commodities that you're looking at.
Okay. I'll just,
3 or 4.
The big one, I guess, I'll just do year-to-date numbers. We're about halfway through. Lumber's up 80%, housing. Corn, 55%. Lithium, batteries across everything. If you have anything that has a battery in it, that's lithium. Up 92% this year.
So for the audience, compare this. These are the costs. This is how much things have increased in cost. Yeah. So if you go to the grocery store, if you go to Home Depot to get lumber, things are going to be much, much more expensive than they were last year at this point.
Milk's up 20%. Milk is up 20% this year. Cheese is up 10% this year.
So all of these things, you start combining these things and looking at how much they've increased in cost year over year. And somehow we're supposed to believe that the inflation is only 4%. And this is what you're saying, where the differences are.
Yeah. I mean, with their basket of goods and services that they select, it's 4%. I mean, whether it's 4, whether it's 5 or 6, it doesn't really matter. All we know is it's up. It's higher than they wanted. We'll see how that continues or doesn't continue, or if you start taxing the living daylights out of the economy, which is what the Democrats are going to try to do. Which I understand why. They're writing a lot of checks. You got to hopefully balance the other side. But all that aside, we got an inflation problem, and this shouldn't be a shock to anyone. The U.S. dollar is getting hammered because of, even if you ignored the trillions of dollars that we pumped into the economy, there's a currency war. Every economy in the world is struggling. So everyone at the same time is trying to devalue their currency relative to others. So they're losing that fight. They were losing that fight. And then we just keep printing more money.
Right.
That's just going to even further the erosion of the U.S. dollar.
Okay. Well, let's talk about what I want to bring out here is how we manage risk during inflationary periods like this. What do we do?
We hold things that do well in those environments. The easy answer, the short answer is commodities, because they go up in these environments. Too many people, my peers, they think that you only can invest in and buy and sell stocks. Like, there's a whole other world out there. There's multiple other worlds out there that, they just completely, they don't know how to trade this stuff. And it's not too different. It's just, you learn, too many people, and I understand why, because I for a long time was in the same trap as well. As whatever firm you come up in, that firm has a way of doing things. They do it like this, and you look at this, and you don't look at this. And that's just how, some people will eventually look around and be like, none of this makes sense. We're ignoring a lot. And, I grew up as a technical trader. I did, candlesticks and point and figures. That was my wheelhouse. But one of my undergraduate degrees was economics, and it just I always had this weird feeling like we're ignoring so much. Like we're missing the boat. And technical trading works until it doesn't. And when it doesn't, it blows your face off. And it's like, I don't understand what's going on. It's like, well, you're not paying attention. You're only looking at the data specifically to that whatever you're trading. And usually it's stocks, and just people, it's like a moth to the flame. That's the only thing anyone pays attention to. If you're not paying attention to commodities, currencies, and bonds, you're going to get surprised. And I know I'm sidetracking from the question was, what do we do in these environments? We hold things that do well in inflationary environments, but the big one is commodities.
All the things we were just talking about, the
energy. I mean, that's commodities. There are, depending on there are short-term correlations. That's the one wild card that always changes, but never changes, is on a short-term and intermediate term. And I'm talking 30, 60, 90 days, there's these inverse correlations that can just appear out of nowhere. That out of nowhere is a bold statement, but like inverse correlations between property A and property B, and it will last for 30 to 60 days and then it will go away. And if you're not measuring, mapping things on a daily basis, it'll take your head off. It's just, there's the world is an ever changing, ever evolving machine, and there's wars, there's not wars, there's famine, there's a bazillion different things that can cause relationships to occur and then unoccur. And if you're not at least have your head on a swivel to see those things, to either take advantage of them or get the hell out of the way, most important, you get surprised.
Yep. So the point I was trying to make is that even when there is fear on the streets regarding inflation, there are things that we can do. You just got to look at other places and turn some rocks over and say, here's what we need to look at.
Commodities and financials.
There is a question, and we're going to totally jump into a completely different subject. And I've got opinions on this too, but I want to hear your opinion. Cryptocurrencies. What are your thoughts?
I actually had a really long phone call with someone yesterday about this, who's well more into this than I am. First and foremost, that is not my wheelhouse. I'll give you my opinion on it, but I am by no means an expert. I can spell crypto. In my opinion, and asterisk the hell out of this, it's not a currency. Right. It's currently is. It's not. Name one person that bought anything with any of these things. It's not a unit of exchange yet. We'll see. I would bet almost everything. No, that's a lie. I'm not going to bet anything on anything. I don't see it. Well, it'll trade at some point. It'll turn into just another commodity that gets traded. Is my hunch of where it's going to go. You can make a lot of money on it. Some of there's more validity to it. Bitcoin, Ether, those things, there is some more validity to it. The whole Dogecoin thing,
right?
Even the guys that I know that do know this stuff, one of which I had a 2-hour phone call with last night. He just jokes about it. He's like, I have no idea. Like, this is just Reddit at its finest, pumping things up, and they're really excited about it on the way up, and then it's crickets on the way down. So we'll see. It's, in my opinion, it's a sea of MySpaces with one or two or a handful of Facebooks out there. My opinion is, in a decade or so down the road, all of this was going to look so obvious. They're like, why were we buying what coin? I mean, like, it's just going to be so obvious. There will be a few players in it still around.
Yeah. On that note, I'll jump in my opinion because we're running out of time, and I know you're just rambling at this point. You've already said that's not me. I can spell crypto. Yeah. So I have been doing a lot of book reading and a lot of reading on the various cryptos and blockchain technologies at this point in time, and it's really intriguing to me. I will agree with you that right now it is 100%. There's so much that still needs to be developed for there to be a lot of value, ongoing value. But I do believe there is a future. So if you just step back to the year 2000, when the .coms were coming out, there's .coms for everything. That's exactly where we are with the cryptos right now. There's all kinds of coins out there, and they're developing technologies, and they're trying to see what's going to work. And that's what was happening during the .coms. Now, past the .coms was those .com bust. That didn't mean that .coms are not around today. Obviously not. The internet's around, and it's made a gazillion dollars. But certain companies, Googles of the world, things of that nature, came out, and they were born there. And now it's changed our world. And that's how I believe that technologies will change the world in the future. But it's still a ways off. But it's good to continue to read and stay updated. But you do have to wrap your head around the way business works today, the way the internet works today, and what blockchain is designed to do for the future. And the whole idea behind it, and I've got a few minutes, so I'm going to ramble myself, but the whole idea around blockchain is to make the internet more trustworthy and make contracts more trustworthy, so you don't have to have intermediaries, aka everything is a bank is an intermediary. I mean, before I send you $1, I've got to use my credit card or a bank card, and it's got to go through the bank to get to you. And so there's all these intermediaries that say, trust me, I'm the bank. And I make sure that there's money in that account to pass to you. And all that is the future of that is, why do we need that middleman? And so the whole idea is, when you look at society and you can tell where there's inefficiencies, look at where lines are. I mean, you call Bank of America and see how long you wait on a line to talk to somebody. There's inefficiencies there. You go get a title for your car, or go get anything like this, there's lines. Get a driver's license, there's lines. There's a lot of inefficiencies in today's world, and the reason they're there is because they're verifying a transaction. So the entire technology behind all of this is to make that much, much simpler. And I love efficiencies, so I'm reading the study and all this stuff, and I think it's a great thing. But in the future, like today, what you pointed out, it is the Wild West. And so there's going to be a lot of, especially as they're coming at the Dogecoin was a joke, and it's made a lot of people a lot of money, but it's also, people, for every time that you hear somebody make money, there's a ton more people that have lost, they took the money from, right? So I would say, read as much as you can. I do think that's what's called Internet 3.0. It's where the society is going, because that's where they want to go. Because why? You just made a really distinctive point in our earlier conversation about governments. The reports that they put out, it's a narrative. It's false. You have to read through the whole thing to kind of decipher what's the truth behind this. Yep. Well, if people around the world, their currencies are losing value and they don't trust what their government's saying, they're looking for truth. They're looking for more transparency. And that's where this is all going. And the reason that there's this values to Bitcoin is this not government controlled. And so it's like, we're trusting the technology, not people that can put a narrative to it. So there's my 2 cents for the probably 5 books I've read on it so far. But I am up on it because it's part of finance. And I think that as the future of finance, we have to stay on it. You're keeping your eye on the ball on all the local stuff that is working. I'm looking at some of the stuff that's coming down the pike and making sure that we're versed there as well. So
one thing that I will say that I think I've told you've heard this or I've discussed this, the thing that will change crypto significantly is if the barriers to entry become a little easier to get in to trade it, like all the trading platforms are these off name, no one's heard of them, like Coinbase is now the new or the most well-known one in there. But to serious crypto people, it's a joke. You can only trade a small number of them, and I guess their system kind of sucks.
There's limitations. And to your point, the whole reason, if you think about the reason for the technology is to make things, a lot of things, to make things private, to make things, governance hands off, that kind of stuff. And then you have this intermediary like Coinbase, which is being a bank. And they come in, Robinhood does the same thing, some other things. They come in and say, we'll let you trade on our platform, but we're going to put rules on it. Here's what you can trade and here's what you can't trade. Well, that's still, it's not the purpose of what the technology is for. So I agree with you there. So hopefully for that person that answered that question, John, hopefully that gave you some insight into how we look at things. But yeah, we're looking at it. We're studying but right now it is Vegas. So it is black or red, keep your eye on the top 10 coins and research what they're doing, because the one thing that about Dogecoin had no purpose. The Doge had no purpose. It was a joke, and people still bought it. Doggy coin.
I like to call it doggy coin because it's dog shit.
The Doge, yeah. But it had no purpose. Things like Ethereum, things like Bitcoin. There's a solid purpose. There's a lot of people behind it. So it's really going to be what comes up to the top, what value they're providing, all of that. And so keep your eye on the top 10 and just, look at what they're doing and how they're different, how they want to improve the world. And I'm confident that people that invest in the stronger ones will have some and hold, buy and hold and kind of see where it goes, because it is going to be a time before the technology is sustainable for businesses, like you said, to transact. I was having a conversation with the president of Austin FC yesterday, and they were wondering whether they should start taking crypto. And so companies are starting to wonder. I've talked to a lawyer recently who just started accepting crypto. So it is coming, just a matter of giving it time. Well, once again, this isn't investment advice, rather a conversation, as you saw, between me and Sean, how we do things, what we look at, take some questions from the audience and try to give our opinions on that. But it is educational in nature only. If, however, you want to discuss things about your portfolio or how interested in doing anything else we can help with, financial planning, we do a lot of hours that help people on financial planning, please let us know. If after this you want to hear this, the recording now with this new service comes automatically. You get to capture this recording. We will also get a more edited version on our website in the coming weeks. I want to thank everybody. We made it right on time, 1:00.
Here we go.
And have a wonderful day. Take care.
Adios.